Quick math question. 2 years. That's all I need. Year 1, your investment drops 50%. Year 2, it bounces back 50%. What's your total return? Most people say 0. Even some financial advisors say 0. The actual answer is negative 25%. You started with $1,000. After a 50% drop, 500. After a 50% gain on that 500, you're at 750. You lost a quarter of your money across 2 years that averaged 0% return. Now here's the part that should stop you cold. Your entire retirement plan is built on averages, and averages, as I'm about to show you, can be mathematically correct and financially catastrophic at the exact same time. The people who retired in October 2007 found this out, not because they did anything wrong, but because the promise they were sold didn't come with the footnote that would have changed everything. Every retirement projection you have ever seen comes with a number at the top. Assuming a 7% average annual return, based on historical averages of 8%, your portfolio growing at an assumed 6.5%. That number is real. The S&P 500 has genuinely averaged around 10% annually over the past century, roughly 7% after inflation. That is not a lie. That is documented, verified, repeatedly confirmed across 100 years of market data. The problem is what that average conceals. Averages flatten time. They take all the years, the catastrophic ones, the extraordinary ones, the ordinary ones grinding in the middle, and compress them into a single, clean, presentable digit. And in a spreadsheet, that digit behaves beautifully. Assets accumulate. The line curves upward, the client smiles. But you do not live inside a spreadsheet. You live on a calendar. And on a calendar, the order in which those returns arrive changes everything. Let me show you exactly what I mean with a real decade. Between January 2000 and December 2009, a full 10-year stretch, the S&P 500 delivered a total return of negative 9%, not negative 9 in a single crash, negative 9 across an entire decade. 2 separate market collapses sandwiched around a brief recovery, the dot-com bust, then the housing collapse, producing what historians of finance call the lost decade. If you were 40 years old in 2000 and still working, adding to your portfolio every month, the lost decade was painful but survivable. Time was on your side. Markets recovered. Your contributions during both crashes bought cheap shares that exploded in value after 2009. But if you were 62 and had just retired, you were selling shares, not buying them, throughout the worst decade in modern American market history. Every dollar you pulled from that portfolio to pay for groceries, utilities, healthcare, every single dollar came out of a portfolio that was bleeding. You were not buying low. You were being forced to sell low. Repeatedly, for 10 years, that distinction, a buyer versus seller during the same crash, is the entire difference between a retirement that survives and one that doesn't. And it has nothing to do with how much you saved, how carefully you invested, or how faithfully you followed the plan. Let me tell you about someone. I'm going to call Patricia. Patricia was a high school history teacher in Ohio, 34 years in the classroom, methodical saver her whole career, maxed her 403B, which is just a 401k for public school employees, every single year for the final 15 years she worked. She sat down with her financial advisor in the summer of 2007, portfolio at $890,000, clean 60-40 allocation between stocks and bonds, withdrawal rate planned at 4%, $35,600 a year, supplemented by her teacher's pension and partial Social Security. The advisor ran the projection. The line goes up and to the right. Comfortable margin should carry her past 90 with money left over. Patricia retired October 1st, 2007. 14 days later, the S&P 500 hit its all-time high. Then it began what would become a 57% collapse over the following 17 months, the single steepest drop since the Great Depression. Assets in 401k accounts across America lost $2.8 trillion, roughly 1/3 of their entire value, between September 2007 and December 2008. Patricia's portfolio fell from $890,000 to approximately $520,000 by March 2009. In that same window, she had already withdrawn $71,000, money she needed to live on, pulled from a portfolio in free fall. Now here is the mechanical reality that makes this hard to fully absorb. When Patricia's portfolio fell from $890,000 to $520,000, she didn't just lose $370,000 in paper value. She lost the compounding engine on $370,000 worth of shares that no longer existed in her account. Those shares could not participate in the recovery that eventually came. They were gone, spent, converted into groceries and utility payments and the mundane cost of being alive. And the shares that remained, the surviving $520,000, now had to fund 30 more years of retirement entirely on their own. Markets did recover. By 2013, the S&P had climbed back to its 2007 peak, but Patricia's portfolio was recovering on less than 60% of its original foundation. The math had permanently shifted in a direction that no recovery could fully undo. Now consider her colleague, a woman who also taught at the same school. Similar savings, similar portfolio. She retired in April 2009. She walked into retirement at the exact bottom of the crash. Her first 5 years ran on a portfolio that doubled. Every withdrawal came out of an expanding balance. Her compounding engine was intact and accelerating from day one. Same school, same district, same general financial advice from the same general industry. Patricia's retirement became a source of continuous financial anxiety for the rest of her life. Her colleague barely noticed a crash had happened. The only real difference between them was 6 months on a calendar. And one of them drew the short straw, not because of ignorance, not because of carelessness, but because the promise she was sold had a second half that never got spoken aloud. Here is what I want to be precise about, because this matters. The safe withdrawal rate, the percentage your advisor put on the board, is not a fabrication. William Bingen's 1994 research was real. The academic foundation behind modern retirement planning is legitimate. The projected averages are drawn from actual historical data, but they carry a structural assumption, an embedded condition, a second half of the sentence that almost never gets spoken in a planning meeting. The model works when you have time to recover before you need to start drawing. That is the entire footnote. Those 17 words, during accumulation, while you are still contributing, still buying, still compounding, a market crash is an inconvenience at worst and a discount opportunity at best. The recovery works for you. Time is your ally. During distribution, once you are withdrawing, once your survival depends on the balance, a market crash in the early years is a different kind of event entirely. You are selling into the loss. Every withdrawal permanently removes shares that would have participated in the recovery. The recovery still happens, but it happens in a smaller pool. Your portfolio is running on diminished compounding capacity for the rest of its life. The financial industry has had a technical name for this for decades: sequence of returns risk. It has been studied extensively. The Financial Planning Association has published peer-reviewed papers on decision rules specifically designed to manage it. Morningstar has dedicated substantial research resources to it. Vanguard's own behavioral research found that the average equity fund investor underperformed the S&P 500 by 4.35% annually over a 20-year window, largely because of emotional selling during exactly these kinds of crashes. Nearly 60% of investors who sold during the 2008 to 2009 crisis were still sitting in cash 3 years later, having missed a 50+% market recovery. The knowledge exists. The research is available. The risk is well documented within the profession. What is rarer is the conversation in an actual planning meeting where a client heading into retirement is shown the bad timing scenario. Not the average case, not the base case, but the Patricia scenario. And asked explicitly, does your current plan survive this? Near the peak of the 2007 market, nearly 1 in 4 Americans between the ages of 56 and 65 held more than 90% of their 401k balance in equities. These were not gamblers. These were careful, disciplined people who had been told that a diversified growth portfolio was built for this kind of volatility. Nobody walked them through what built for this kind of volatility meant specifically in the 5 years after you stop working and start withdrawing. The promise had a footnote. The footnote was the whole story. If you are currently somewhere between 55 and 70 years old, you are living inside what retirement researchers formally call the retirement red zone, what some Morningstar analysts refer to specifically as the danger zone. It is the 10-year window, roughly 5 years before your planned retirement and 5 years after, where sequence of returns risk reaches its peak destructive potential. Your portfolio is at or near its lifetime high. Any percentage loss now hits you in absolute dollar terms harder than at any previous point in your financial life. And you are either approaching the moment you flip from accumulation to distribution, or you have already flipped. Run the math on your own situation. A 40% correction when your portfolio is worth $200,000 removes $80,000. Painful? Recoverable if you stay invested and keep contributing. A 40% correction when your portfolio is worth $1.1 million removes $440,000. And if you have already started withdrawing, a significant portion of that loss is not temporary. It is structural. It changes the compounding capacity of everything that remains. The S&P 500 has experienced corrections of 40% or greater 3 times since 1999. That is 3 times in 26 years. Anyone who entered the retirement danger zone during any of those 3 windows had their plan exposed to the footnote that was never disclosed. There will be more corrections. Nobody knows when. Nobody knows which year will be the year the calendar turns against someone who has done everything else correctly. That is not pessimism. That is just the documented behavior of financial markets across the history of their existence. The question is not whether you will face volatility. The question is whether your plan's structure accounts for the specific damage volatility causes during the specific window you are currently inside. The answer to the sequence of returns risk is not a lower withdrawal rate. I want to say that clearly because that is the natural first instinct. I'll just take out 3.5% instead of 4%. A lower withdrawal rate means you spend less of your own money. It does not change the mechanical damage caused by selling a declining asset to meet living expenses. The math is the same at 3.5%, just with less money spent. The actual protection comes from removing the condition that makes sequence risk dangerous in the first place, the forced sale of long-term assets during a short-term downturn. Build a cash firebreak that is not your portfolio. This is a dedicated pool of liquid money, high-yield savings, money market short-term instruments, large enough to cover 12 to 24 months of your actual living expenses, not your portfolio, not your bonds, completely separate. Its job is not to grow. Its job is to exist between you and your long-term investments during any period when your long-term investments are down. When markets drop 30 or 40%, you live from the firebreak. You do not touch the equity portfolio. You give it time. 1 year, 2 years, however long the recovery takes, before you resume normal withdrawals. The shares that would have been sold at the bottom are still there. They participate in the recovery. The compounding engine survives intact. Patricia did not have a firebreak. When her portfolio dropped, she had no alternative source of living expenses. She withdrew anyway. She sold into the loss. The firebreak would not have prevented the crash. It would have prevented the permanent damage the crash caused. Manage your equity exposure relative to your window, not just your age. The conventional approach says, hold your growth allocation until retirement, then gradually shift conservative. The research says the critical shift should begin earlier, specifically during the 5 years before retirement, when your portfolio sits at peak value and the damage ceiling on any crash is at its highest. This is not about abandoning growth. Your long-term portfolio still needs to outpace inflation across a 30-year retirement. It is about recognizing that the 5 years before and after your retirement date are fundamentally different from the 30 years of accumulation that preceded them. Different risk profile, different consequences, different strategies required. Have a bad timing conversation before you need it. Ask your advisor directly and specifically to model the Patricia scenario for your plan. What does your projected retirement income look like if the market drops 40% in year 2 of your retirement? Not year 20, year 2, get a number. Understand what it means. Know in advance what you would do, and whether your current structure gives you any choice other than selling at the bottom. That conversation should happen before you retire. Not during a crash, not after the damage is already structural. 50% down, 50% up. Feels like break even. It's negative 25. Your retirement plan's projected average return is technically accurate, the same way that math problem is technically accurate. The number is real, the calculation is correct, but the number hides something that the calculation does not show, which is that the order of events, the timing, the specific position on the calendar when things go wrong determines whether the math works in practice or just on paper. Patricia saved correctly. Patricia planned correctly. Patricia followed the promise that the industry had been selling for 40 years. The calendar disagreed with her, and nobody had walked her through what the calendar disagreed with actually looked like in her account. You now know what it looks like. You know the mechanism. You know the window you're in or approaching. And you know the specific structural changes, the fire break, the glide path, the bad timing conversation that are the difference between a plan that survives the footnote and one that discovers it too late. The promise was never a lie. It was always just an incomplete sentence. Finish the sentence before the calendar finishes it for you. Pull up your retirement account right now. Find your current equity allocation percentage. Then ask yourself honestly, if that number fell by 40% and stayed down for 18 months, do I have anything outside that portfolio to live on without selling a single share? If it makes you uncomfortable, that discomfort is the beginning of an honest financial plan. Profit Plot exists for exactly that conversation, the complete sentence, not the simplified version. If that is the kind of financial thinking you want more of, subscribe. New video dropping soon. It will be just as direct as this one.